Awesome. Thank you, everybody, for joining us for Self-Directed IRA. Self-Directed IRA Saturday. My name is Zach Wilson. I'm one of the IRA specialists here at Quest Trust Company. So before we get started, I got to give you the disclaimer. Everything that you're about to see here is for your educational purposes only. It's important to understand the role that Quest will play when it comes to your investments within your self-directed IRA. We're here to offer as many resources and as much education as we possibly can. With that being said, Quest does not offer any sort of tax, legal, or investment advice. So, a little bit about Quest for those of you who don't know us. We are the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country. We have over $2 billion in assets under administration. I think the most recent number on that was 2.7. We have over 100 employees, 34 of which are certified IRA services professionals. That means no matter when you call, you're going to have an IRA service professional that's there to help you with just about any question you could possibly have. And as it stands right now, we have over $400 million in undirected cash sitting in our clients' accounts. What this represents is opportunity. Whether you're a current Quest client who's part of this undirected pool, or you're an investor who needs funds to make your deal happen, this is where your opportunity lies. But before you make any investment, what's always the first step? You have to educate yourself. So please take advantage of our free education, guys. Check out our YouTube channel, check out our website. You'll see hundreds of videos going over everything from the basics of a self-directed IRA all the way to the ins and outs of a syndication and what that looks like within your IRA. So once you've got the deal, you figured out what investment you wanted to pursue, well, the deal's not going to make itself happen. So now you've got to go out and network. Take advantage of our networking opportunities, guys. Of course, we have the classes every Saturday and we have the classes every Tuesday, but also keep in mind we have our virtual happy hour on the fourth Wednesday of every month. The way that works is everyone gets into a big Zoom and we go down the list. You get a chance to introduce yourself. You talk about where you're from, what kind of deals you're looking at. And if you have any deals, you get to actively pitch them here, right? But by far, our most common social is going to be our self-directed IRA socials. Now, these are normally on the first, second, and third Tuesday of every month in Houston, Austin, and Dallas, respectively. So usually how these work is we have 30 minutes of networking, roughly 30 to 45 minutes. Then we have a presenter come out from about 45 minutes to an hour, and then we allow for networking and deal pitching at the end. But this month is different. Coming up this Tuesday is going to be our Austin Sizzling Deals Social. That means it is going to be strictly dedicated to one, networking and building those relationships with other Quest clients and investors. And two, you actually get to pitch the deals you have. So even if you're a lender, even if you just have a pool of funds and you're looking to lend out, come check out our Austin social. After that, it's going to be our Dallas social. And then on the final Tuesday, it'll be our Houston social. This is where you really get to pitch any deal that you could possibly have. And then obviously, guys, we have our Quest Expo coming up. I said it time and time again, this is the best value that we can offer you as a company. You're going to have tons of vendors here. We're expecting anywhere from 800 to 1,000 people to show up. And there's going to be roughly 30 speakers. I think that number is actually climbing now, that they're going to go over all things alternative investments. This is not just something that's for self-directed IRAs. This is for alternative assets in general. So we're going to talk about hard money lending. We're going to talk about syndications. We're even going to have a panel that's going to go over inflation and what the role that alternative assets can play in your portfolio. So come and check that out, guys. And if you get a hold of an IRA specialist, we can get you an additional 30% off. So if you've got any questions, anything at all, please reach out to us. Don't hesitate. We'll be happy to help you. So without further ado, I've got Ryan Smith here. Ryan, I'll let you take it away.
All right. Thanks so much, Zach. And thanks for being here on a Saturday. I know you've got a lot of things I'm sure you could be doing other than watching this webinar. So it tells me that for those of you who are here, you're coming for a reason and hoping to get something good out of it. Or you really just didn't have anything on a Saturday afternoon, and that's perfectly fine. I've got 4 young kids, so I have no idea what that's like, and I aspire to know at some point in the future. So, right. So we are. What I kind of have planned is, a discussion that's hopefully helpful to you, is informative, but I'd also as always, like to get to the questions and not presume, through creating the presentation, what you might be looking for or need or want. So I'm going to try to present some information that might be helpful, ideally things that you didn't know, and then go from there. By way of background, if you don't know anything about me, which I would guess the vast majority fits in that bucket. My name's Ryan Smith. I live in Orlando, Florida, which is where I'm calling from here now. And we're in the mobile home park and self-storage business, have been for coming up on 20 years. We own a lot of property in a lot of different locations and have done it for a long time. So I hope to share some information that, things we've learned, things we've observed that might be helpful to you. So just by way of introduction, we do have an open investment vehicle called Fund 8. I'm not here to sell this, or this is not the focus of my time with you, but by virtue of it being open, I have to say this is not a solicitation to invest in Fund 8. That can only be done by virtue of the PPM, and I'm not going to read the rest of this. I can pretty much hear the sighs of relief in the background, but it is important. There are disclaimers. You should read them, know them, understand them, and consult with your counsel regarding them. So my name, like I said, Ryan Smith. I'm married to Jamie Smith. She is the co-founder of Elevation Capital Group. So Elevation Capital Group is our firm. She and I founded the company many, many years ago. We work together, which there's a whole nother discussion we can talk about. Working with your spouse, which is for us, it's worked quite well and has been a wonderful experience. We have 4 kids, and now this says 8, 6, 4, and 2. They're actually just turned 9, just turned 7, just turned 5, and just turned 3. They're all born, and this speaks to Jamie's administration skills, but they're all born the same week, 2 years apart. So that's a picture of all of our kiddos at a dude ranch we go to every summer. For whatever reason, the one in the middle, Hunter, was none too pleased of the of the photo op, but it's a lot of fun. So, like I said, co-manager of 8 funds. We're in self-storage mobile home parks. We own and or operate more than 20,000 units in more than 25 states. We've purchased more than 100 assets, since we began, and like I said, we've learned quite a bit. We operate under 2 brands nationally, depending on where you are in the country. These may be notable or recognizable. On the storage side, it's Mini U Storage, and we're all over the place. We have quite a few in Florida, DC, Washington, DC, Texas, quite a few in Colorado, Denver, all over California, and many other states. And then on the mobile home park side, we're working to establish a brand called JRB Communities. And this is Jamie, Ryan, Brian. It's the initials of the 3 principals. I'm one of the 3. And basically our brand promises if we wouldn't stay there, we won't let you. So we own really nice mobile home parks that are in some cases shockingly nice. So for the time that, we're together, this is kind of what I thought we'd talk about. And hopefully it hits the mark of what you're looking for. And if not, I want to get to Q&A as quickly as possible. And if you do have questions, please do ask. That's probably my favorite part of these discussions is actually the discussion. So I'll give you a little background on mobile home parks. They're referred to here as MHCs, which stands for Manufactured Housing Communities, also known as mobile home parks. And then self-storage, which is the SS. And then the question that I'm posing here is why own them together? Why consider owning them together? We actually purchase both in the same vehicle because we have found there are features of both that are additive to one another. They're similar but different in a way that is beneficial to put them together. At least we think so, and we'll tell you what that is and why. And then this concept of kiosk-based self-storage management has popped up over the last couple of years and grown, or unmanned kind of self-storage doesn't make sense. And the short answer is yes and no, depends on what you're trying to accomplish. And we'll talk about that briefly, and then talk about kind of go through the numbers, fundamentally what it is we do and how to add value to manufactured housing communities and or self-storage properties. So we're going to go through a discussion that I hope you find helpful on the value of a dollar and then how to add those valuable dollars to your property. So that's kind of the plan, and we'll kind of go from here. So why mobile home parks, kind of a little background on mobile home parks, just some bullet points as to why we like them. Some of you may have, you're coming to this call saying, okay, I know all about mobile home parks. They're wonderful. I'm already kind of sold on the concept. Some of you might have never thought of it, which is where I was 20 years ago. And it really did hit me like a bolt of lightning. But so a couple of just kind of high level points. One, we like manufactured housing because it's at least presently, and it has been historically, experienced constrained supply. So presently, there's about 55,000 mobile home parks in the United States. In any given year, there's somewhere, based on what we could find, somewhere between 10 and 20 new mobile home parks developed every year, new mobile home parks developed every year. So there's 55,000. There's about 10 to 20 that are built every year, and there's about 150 that are torn down for highest and best use of the land. It's actually kind of, an interesting statement that where I sit right now as I'm talking to you, less than, I'd say, a mile away, 2 years ago was a mobile home park. Today is a brand new shopping center with a Starbucks on the corner. So that is a mobile home park that was taken out of supply for highest and best use of the land, which as a general statement, the highest and best use of the land is typically not mobile home park. And so there's some value and some options and opportunities there over time. But we like owning mobile home parks and maintaining them as mobile home parks. But there's a constrained supply component, which we like. And then demand for mobile home parks, or demand for affordability at large, is growing. And in this bullet point, I don't need to really, I don't think, spend a whole lot of time on. I'll just leverage hopefully what you have as an understanding of the market, which is as a very general statement, and it is purely my experience. But over the last 20 years, ever since I got into the business, affordable housing has been not only needed, but growing pretty steadily for the last 20 years. And in the demand for affordable housing has seemed to be, and you'll see this a little bit later in the data, but it's seemingly non-correlated to the broader market in that, in 2007, when the market was going sky high, a year ago when the market was sky high, affordability was the cry of the day. We need more affordable housing. And then in 2008, 9, and 10, and then now, and probably in the future, the cry of the day was affordable housing. In fact, I think this week there was a headline, I think it was even yesterday in the Wall Street Journal, that said a stat that said something to the effect of affordability, the demand for affordable housing is the highest point since 2006, or maybe it was the inverse of housing is the least affordable since 2006. It was something to that effect. But the point is, as we sit here today, I think we can all agree, no matter what side of the aisle you are on, which is pretty fascinating, that affordable housing is something that is needed. And then it is our view, as it has been in the past, our view that the trend, that the demand for affordable housing will continue in the future. We do not see a quick, easy solution that will solve this issue at scale in the next 10 years. So in short, we have an instance of constrained supply, and we have pretty significantly growing demand, and that contributes to rising price pressure. And you'll kind of see this in the data in a minute. We like them because we like mobile home parks because it's real estate based, and it produces cash flow to varying degrees depending on the location, the size, the quality. As a general statement, you might be able to earn higher amounts of cash flow by buying riskier assets, and lower cash flow by buying higher quality assets. We, as a general rule of thumb, we focus on quality because we think over time you want to own quality things, and especially in times like these, we think. It's just my opinion, but I think in the next couple of years, you'll want to be into quality assets as opposed to not quality assets. Mobile home parks, as a general statement, have low operating expense ratios. And I'll give you kind of the basis for that statement. There's certainly, you can go higher or lower, but as a general range, you should be somewhere in the 30 to 50% range in terms of OpEx, the cost to operate the business as a percentage of revenue, 30% to 50%. And that's a pretty wide range. And it really comes down to do you want to own the homes or not? So what I mean by that is when I say mobile home parks, what I will get occasionally is people say, well, I don't want to own the mobile homes. And, probably little did they know that we agree with them, at the beginning. We own mobile home parks. We own the land. We do not want to own the homes. We want to lease the land, whereby all of the residents own their own home. Now, it does happen from time to time where we do, in fact, own a home or two, but it is not our core model to own all of the homes. So if you do, and though on the flip side of that statement, if we bought a mobile home park and owned all of the homes and rented the homes and the land out, then our operating expense ratios, which would be much higher because we're now having to maintain the home, in all of its, kind of guts, so to speak. So 30 to 50% as a rule of thumb. The goal is to be on the lower end of that ratio, obviously. We also like the longer term nature of tenancy. So they're sticky customers. Typically when people move in, they own their own home. They typically stay for about 7 years, which is actually when they own their own home in a mobile home park, it's actually a similar duration to somebody who owns their own home not in a mobile home park. So the average homeowner nationally, from the data I saw recently, stay in their home about 7 years, or they sell every 7 years. And it's actually a similar time frame with mobile home parks. So it's a longer term tenancy. And just for clarity, the average, if somebody buys a mobile home, let's say in the mobile home park, and it's their mobile home, they will likely move and sell their mobile home, not move it out, because the cost to move a mobile home can be today it's gone up significantly, but between $5,000 and $10,000 is what you would pay to move a mobile home inside of a city. So it's not when a mobile home moves in, the person who owns the mobile home may sell the home and leave, but the home stays for typically 20 to 25 years. So again, for all of those reasons, we like mobile home parks. Storage, a lot of similarities, but a couple of things. So we like we like self-storage because there's very broad adoption. Presently, about 1 in 10 Americans are customers of storage. And so if you're on this call and you're a customer and you have something stored somewhere, on behalf of the wider industry, we thank you. But broad adoption, and it's growing. The adoption rate is growing. So interestingly enough, like I said, 1 in 10 Americans use storage, but for millennials, there is data to suggest that about 30% of millennials use storage. And they use it a little bit differently as a whole. They're leveraging storage. And before I talk about that, let me just briefly mention, a lot of times when you talk about storage, people, I'll say, people say something like, well, they kind of equate storage to a form or version of hoarding. It typically kind of like, well, those storage are for people who just buy stuff, and it's kind of a version of hoarding. Not wholly true. Not to say that doesn't happen at some points, but about 30% of our business is business, and businesses looking to store clothes or machines, equipment, different kind of inventory. It just depends. But 30% of our business is business. And then what storage really benefits from is friction in movement in the market. It doesn't matter up or down. It just movement matters. So as people are in an expanding economy, going from smaller to bigger and consumptive and buying, that typically benefit storage because they're moving and they need storage to kind of fill in the gap. And then the opposite is true in a contracting economy. As when people are moving left, right, up, down, and storage tends to benefit. But one of the things that's interesting, kind of when I mention millennials, is there's a tendency that millennials are actually using storage to, in some cases, save money. And the way they're doing this is they're renting a lot of times, or buying homes, let's say, or apartments without a garage attached. And by doing so, save the money. And they're using storage as kind of an extension of their garage, or their first garage, so to speak, or maybe an extension of their garage. So they store their bikes or their kayaks and they'll come on Friday, pick them up, and return them Sunday night. And so, interestingly enough, the adoption rate is and it seems to continue to grow. Again, not only the adoption rate as a percentage of Americans, but also on a square foot basis per person, that is also growing. In the 90s, Americans used about 3 feet in a market, in any given market, on average, about 3 feet of storage was demanded per person. And they said, well, it'd never really go much more than 4, but it did. It went to 4, and then it went to 5, and then it went to 6 and 7 and 8. And now it's almost 9 feet per person of storage. And the projection is by 2030, I've seen this, not by us, but that many are projecting that it'll be above 12 feet per person. So as you know, the reason I say this is, when you're looking at a market, if you're saying, okay, like we like Washington, D.C., for example. So, and we just bought a storage facility in Alexandria, Virginia, in a growing area near Amazon's HQ2, where they're hiring people and bringing people in. So for us, if we look at that market and we say, okay, well, let's say there's going to be an expansion of demand 3 feet per person in that market over the next 10 years. And let's say there's going to be, I'm making up these numbers just to evidence this or to walk you through it, but let's say there's 100,000 new people projected to net move into the metro in the next 10 years, a 5-mile radius, let's say. So you say 100,000 people, 3 feet of storage is expanded. That's 300,000 feet of storage that will be new demand in the market. Plus the 100,000 people that are moving in will be a net new 9 feet of storage. So that's 1.2 million square feet of new demand in that market, plus 3 feet of new demand for every person that was in that market or is in that market presently. So you look at that and you say that could be, and I'm just ballparking it, let's say that's 2 million feet of new storage over the next 10 years that's needed. Then when you look at the market and say, okay, well, how easy is it to provide 20 new 100,000 foot storage facilities? And in Alexandria, it's really difficult to build. So it's somewhat moated, which is why we like that space. And so we like storage because it has broad adoption. It's a lot of the trends are we think, benefiting the asset class. We think it is doing well and will continue to do well. It's again, real estate that produces cash flow to various degrees. Easy to maintain. It's easy to manage storage as a general statement. This is data from us, but one of our pools of assets, the average tenancy as of the date that I pulled this, which I think was a couple of months ago, was 1,100 days. So our average, basically what this is saying is our average customer, they may come in on a weekend saying, hey, I need storage for a stopgap. I need it for 3 months. But they end up staying for nearly 3 years on average. And so it's actually a stickier customer than many people imagine. And the reason, just in the statement, is a lot of people start with storage thinking it's kind of a want, it's kind of a want, but then it transitions pretty quickly to a need. And we think that's a kind of a nice feature of the asset class. And again, low operating expense ratios. Storage can be in some cases lower than mobile home parks. As a general rule of thumb, they can range between 25 and 35%, obviously plus and minus of that depending on how one operates. So anyway, that's why a little background on mobile home parks, a little background on self-storage. So just this is the question I posed at the top of the call. So why own them together? And so I'll treetop it for you real quick. And in short, the data I think you'll be able to see this. Now, this data is about a year old, but the new data is not much different than this. There's not any kind of stark deviation from this from what I've seen. But this data goes all the way back to 2000. So it's about 21 years of historical data. And we're going to talk more about this in a minute. But what this is measuring is net operating income over time by asset class. So this is not our data. This is from NARREIT, is I think the underlying raw data. You can go to NARREIT, download the data tables and run your own analysis if you'd like. But the source of this graphic is City Investment Research. But if you basically what they do is they go back to base year 2000, and it's 3, 2, 1, go, and they track the net operating income growth. All stores, all asset classes are given a base dollar amount of $100 of NOI per asset class, and then they grow from there to see how they're tracking on a comparative basis. So you can see over time, that where we are today, they've separated it out so you can really clearly see where everybody is. And number one, from point to point, 2000 to at least the time of this data, which I believe it's still the same today, is manufactured housing. And it's a pretty significant win. And number two is self-storage, close behind it. And then there's a distant third of multifamily housing, which is incredibly popular today and has been for the last couple of years from an investment standpoint. Industrial is number fourth, shopping centers, office, and mall. And so what you can do is you can go back in time and you can say, okay, how did the income fare in different periods of time? So you can go back to see 2007, 8, 9, 10, the asset class at large. This isn't even saying, well, we're better or worse than, but assuming we're as good as the average, let's say person in the industry, you can see the net operating income growth for manufactured housing is really pretty smooth. It's still going up, but it's not going up faster or it's not going up slower than it was before. It's just kind of unabated, continues to go and grow. And so what we look to manufactured housing as being fairly, I would say, inelastic, in that it's pretty historically consistent and smooth in terms of its rate of growth. You don't see a lot of dips and crashes and craters historically. Now on self-storage, it is a little bit more elastic. And so by elastic, I mean when what we have come to realize about storage over many, many years is when in periods of like 2008 to 2010, you can see as a general statement, its net operating income growth was somewhat flat, but it shot out of the hole, which almost like elastic, if you think like a rubber band, if something holds it back, ideally you want it to be able to catch up fast. And so you can see the self-storage industry, not only did it was kind of close in 2007 to manufactured housing, kind of went flat for a couple of years, but then ran to catch up and actually slingshotted manufactured housing, and then actually went ahead of it. And so anyway, it's a little bit more elastic. So we like to build our funds to include both asset classes because we like what we see and view as kind of a more historically more boring in a good way NOI growth curve coupled with the elasticity of self-storage. And for those of you who've been tracking the self-storage business, and I'm happy to discuss this maybe in the Q&A, but the last year and a half has been just unbelievable. The amount of growth that the industry has seen in terms of revenue growth. It's really been something. This is a chart from Green Street Advisors that's from 2018. I could not find an updated version of this chart that shows the same data, but as of, just to disclaim, this is as of 2018. I believe it would be similar today, but I could not find an updated chart from them that was 2021, 2022. But what this said at this time, at least as of 2018, was the 10-year prior total return for manufactured housing was number one, self-storage was number two. Then it went down from there. And then when you look at beta, what's called sector risk, the beta is, if you're, beta is, said another way, it's kind of like correlation to the broader market. If you look at, for example, if you take a beta of one, a beta rating of one means if the stock market goes, let's say, up $1, or goes up 1%, your investment might go up 1%. It's dollar for dollar. Whatever the market does, it tends to follow. A beta of 2 is significantly correlated, but more so to the market. So if the market goes up 1%, what you own might go up 10%. If it goes down 1%, it might go down 10%. But a beta under 1, like 0.3 or 0.4, means if the market goes up or down, it goes up or down less. It's less correlated to the broader market. And so when you look at this, and any of you who want to do this, you can go like Yahoo or Google, type in maybe a REIT in an industry like storage or manufactured housing, and you can look at the beta rating and what their beta rating is, and you can kind of see what it is there, at least for that security. But anyway, on the beta rating index, you can look at manufactured housing is the lowest, has the lowest beta rating, the lowest correlation to the market here. Self-storage is the third lowest, but the returns were the highest too. And so there's this, this, at least based on this ability to historically generate a return without being as correlated to the market in order to generate that return, which I think is an interesting thing. So there's also forward-looking, kind of things that these companies put out. This is from Green Street. And in short, out of what they're basically saying here is manufactured homes, number one, in terms of what they project out into the future, at the property level. And then self-storage is number 6, but it's kind of within the same grouping of net lease, healthcare, single family rental apartments is all, really, within 0.1 or 0.2 of each other, so to speak. So anyway, it has been good. It is good. We think it'll continue to be good. So do kiosk-based self-storage models make sense? This was a question I posed at the onset. I'll just give you some pros and cons real quick. So, one is, and I'll tell you how we do it. This isn't to say that this doesn't make sense for you. You may see the world differently. You may take a different tact. That's perfectly fine. Certainly not trying to make this prescriptive, but our view is the customer matters. The customer experience matters. Our brand standard is Disneyland clean, because we want to provide the kind of service and experience that we ourselves would want and enjoy and pay for. I tend to shop at grocery stores that have clean floors, clean windows. There's something about dirty floors and dirty windows that I don't go to restaurants with dirty floors and dirty windows. Maybe it's just my OCD-ness, but I don't trust. I tend to not trust the people in the back of house if you're not willing to give me a good experience in front of house. So, and the same is true in our business. So, as a general statement, and in general, not specific, but I mean, we want you to have a great experience. So when you're walking around the facilities, you should not see a scrap of paper on the ground. You shouldn't see any trash. Our managers walk the property 3 times a day looking for anything that they can pick up. Some of the little nuances, when you're storing something, if you're storing on the interior of the building where your unit is inside the building or upstairs, one of the things you do not want to have to look for is a cart to haul your stuff. And so our managers reposition carts at least 3 times a day so that every door has at least 1 cart inside of it. So you, the customer, number one, you see no trash. You don't have to look for carts. When you access your unit, again, interior, exterior, our managers will come to you and bring you ice cold bottles of water that are branded with our brand on them and greet you. Not to be nosy, but just say, hey, wanted to bring you some ice cold water. I thought you could use it. It's a free peek at what you're doing to make sure you're there for good reason without coming off as, as a security check. But it also leaves a positive experience. So we think there is a real compelling reason to use people in your management team and experience. But for those who are buying smaller rural storage facilities, the challenge with human labor is the cost is proportional to your revenue, probably pretty significant. And so a lot of people say, okay, well, if I'm buying a 20,000 foot facility in a tertiary or smaller market, well, I can see the need there because you really can't afford the human labor, customer experience. There might not be as many options in that market for the time being. So customer experience may not matter as much, so to speak. And so there are some instances where I think it makes sense. And there's a lot of hybrid kind of kiosk solutions that are popping up that are trying to bridge the gap of the human experience with technology And we're definitely watching those as they develop. The other one is for pure kiosk-based storage management. We've seen operators that it's just literally a kiosk in the lobby. You can rent the unit and all of this. And we've actually seen some of the data feeds, some of the unit pricing. I'll say it this way: either they knew something we didn't know, or we knew something they didn't know. But we thought their data feed was grossly wrong as to what they could have charged in that market. And so there are some risks, there are some negatives, and it can create friction for the customer, which we think is a problem. The positives, it can reduce your cost. And for a remote investor who's kind of passively active, meaning they want to actively buy the properties and maybe spend less than 10 hours a week on management, well, kiosks can support that type of enterprise. So real quick, I'm gonna spend, just for your timeline, and if you're tracking with me on this, hopefully this is somewhat helpful. But what I want to go into now is kind of probably one of my favorite parts of the discussion, which is the discussion around the value of a dollar and how to create value. Because at the end of the day, we buy things that we can make better. We buy properties with the goal and specific intent to make them better, and not just better for the customer, but better for the customer so that they will ideally pay more money over time, which drives both revenue and value to the owners of those properties. And they're happy to do so because it's a superior experience. And so I want to talk a little bit through the value of a dollar, how we add value, give a couple of examples, and then get to questions. So if you do have questions, hold on, we'll address those here shortly. And if you have not yet formulated questions, you probably want to start doing that now, because we're going to kind of hit those here shortly. So I'm going to talk really quickly through NOI as value. And this may be, for many of you, I'm sure this is old hat, not anything too new, but for those of you who, you might be on the earlier part of your investing career, one, don't stop. Welcome, good on you for looking into this, but I would encourage you, please don't stop, keep going. But this might be new. So I'll start just really broad and simple. As a general statement, there's three ways to value a property. You can value a property based on comparable sales. It's called the comparable sales method. For those of you who own residential real estate, you've experienced comps, finding other properties that have sold recently within a close proximity of like type, size, shape, age, use, those kind of things. So that's one valuation method. Another valuation method is called the cost method, the reproduction cost method. How much would it cost in today's material cost and labor plus land to reproduce the value of that asset? And then the third is, broadly simply called the income approach. It's basically the value of an asset is a function of its income, or it's a function of the income that the property produces. So that's largely how we buy and sell and operate our properties. It's based on the income. And so net operating income is kind of the holy grail number. So it's NOI, net operating income. And net operating income is the gross revenue a property produces minus all of its operating expenses, not one-time expenses like CapEx. Like if you have to, in 1 year, let's say patch a road, that most likely would be not a reoccurring operating expense, but more of a capitalized expense. But anyway, not to go down that. But here's kind of a couple of the assumptions for the purpose of this example I'm going to give you. So let's assume that a property would trade at a 5% capitalization rate. Okay. And a capitalization rate, if this is a new term for you, is kind of the real estate equivalent of a PE, of a price earnings multiple. So if you have a dollar of earnings, okay, and in real estate, that would be net operating income. So if you have $1 of annual net operating income, the value of that dollar at a 5% cap rate would be $1 divided by 0.05%, which is 5%. So $1 divided by 0.05 equals, and you would get $20. So 5% cap rate is the equivalent of a 20 multiple on $1 of earnings. Okay, if you want to think of it that way. And a 5% cap rate is actually pretty normal today in this market still for quality, well-located storage and mobile home parks. Actually, less than that in many cases. But so let's kind of go down to the next line. So let's say you have $1 a month of net operating income at a property. Okay, so let's say we all buy a property today, and so the question is, what are we doing to it? Okay, the goal is we want to find ways to add net operating income to the property. We're benefiting from the net operating income that was there when we bought the property, but we want to find ways to add net operating income to the property. So let's say we find, and I think we all could agree, I think we all would agree, that if we put our mind to it, we can find a way. So we could find a way to make $1 a month of net operating income from a property that we buy, storage, mobile home park, for the purpose of this conversation, let's say. So that $1, the question then is, okay, how much is that dollar worth, right? The value of $1. So that dollar is on a monthly basis is $12 a year, because there's a reoccurring component to it. So that's $12 a year of net operating income. Then if we were to take that and value it at 5% cap rate, so 12 divided by 0.05 gives us a $240 value. So $1 a month of NOI at a 5% cap rate is worth $240. So I pretty much tell everybody, including my young kids, that we are in the business of looking for $240 dollars. Okay, that's what we're doing. So what if we found $2? Well, that's $480. What if we found $4? Well, that's $960, and rinse and repeat, and we go from there. So it starts with the fundamental understanding of the value of the dollar. What are we doing when we buy a property? We're looking to add dollars to it, and what specific kind of dollars, not gross dollars. We're looking for net operating income dollars, because we know what those dollars are worth. So with that in mind, there's 5 just really broad strategies for finding those. So just conceptually, and I can maybe in Q&A give you specifics if you'd like them. But when we buy a mobile home park, every now and then we'll have vacant pads. So let's say you buy a 100-unit mobile home park and there are 5 vacant pads in the park. Okay, let's say 1 vacant pad you can rent if you brought in a home and sold the home, so you no longer own the home, but you're now getting $500 a month for, let's just say, the dirt. Okay, so $500 a month. Okay, let's say, for just easy math, let's say you have a 40% operating expense ratio. So 40% of 500 is $200. So that means your net operating income is $300 a month, times 12 is $3,600 a year, times 20, okay, is about $72,000 in value. So every pad that you fill with a home at $500 a month makes you about $72,000 in value. There's 5 of them, which is about which is about $360,000 in opportunity to create value in that property by filling vacant pads. There's other revenue opportunities. So we, on the mobile home park side, you can add cable revenue. You can kind of bulk negotiate with cable providers, and there's cable revenue opportunities. There's we're really picky on the quality of our parks, so we do not tolerate trash in the yards and crap everywhere, because that's not the kind of parks we run, because we wouldn't live in something like that. But we will, if somebody does have things that they need to store, hey, we're in the storage business. We'll either build, if it's a large enough park, we'll build a storage, kind of a mini storage facility on premise that the residents can utilize, or we will bring in tough sheds and we will sell them tough sheds. And so that's revenue opportunities. So there's all kinds of new line items of revenue in the business that we look to add. In storage, you can optimize the unit mix. I know Quest is really big in Texas, and we own storage and mobile home parks in Texas. But we have a storage facility in Katy, Texas, right on the 10. You can see it from the 10 in Katy, right across from Torchy's Tacos. If you happen to be a Torchy's fan, which I myself am, you can pretty much look at me and know that. But anyway, there's a storage facility in Katy, Texas that we bought, and in storage, the unit mix is really important. If you have a bunch of small units, that is a good way of maximizing your revenue, because you can get more per square foot than a very large unit. But the challenge is you have so many small units that you probably won't rent them all. So you have more potential revenue, but you will actually collect less revenue. And on the flip side, if they're too large, your occupancy is going to be through the roof, but your revenue per square foot, your economic occupancy will be through the floor. So we want that optimized cross section. So we bought that storage facility in Katy and actually chopped up the units and repositioned them. They had too many, in that case, they actually had too many small units. And so we had to optimize the mix to actually grow revenue. And that property is doing quite well. You can expand. So we have 2 storage facilities in Las Vegas right now that we're adding about 30,000 square feet to each facility. Both of them utilize toy storage, RV storage, and still do have some component left. We like RV storage and boat storage and toy storage, not for the long term, but for the short term. So the short term meaning, there's the trends, the secular trends favor that. I'm not as bullish on that long run as others. So in the short run, we're generating revenue from those units, which is great. But then at the time that we think it might make sense, we can then convert those units to proper storage, climatized or otherwise, and build, 10 by 10s and 5 by 5s and whatnot. And that's what we're doing. So we can expand. And then obviously always, reduction of expenses. There's this famous story I'll tell you real quick as an evidence of this. So every dollar, so as we talked about earlier, every dollar you save a month, based on that 5% cap rate, creates $240 of value created. And so not only are you looking for, raising rents and pushing revenue, adding revenue opportunities, but also reducing expenses. And there's this story that I heard, was told to me by a friend probably 10 years ago, and maybe even more, about Jeff Bezos in the early days of Amazon, where, as I understand it, he went and was pretty neurotic about expenses. And at one point went to the vending machines in his warehouses and removed all the light bulbs from the vending machines. And his rationale was, there's a cost to replace the light bulb. There's a cost to the bulb. There's human labor. There's energy to power the light bulb. Nobody needs light bulbs to see into them because you're benefiting from the kind of the passive lighting that's in the space. So you don't need it. It's costly. And by saving that, at a whatever the multiple at the time, as I understand it, they would save, tens of millions of dollars and actually create shareholder value equal to tens of millions of dollars based on the removal of light bulbs from the vending machines in the warehouse, is how it was told to me. But the point is, reducing expenses is a valuable consideration. And so kind of the last thing, and then to questions, just to kind of put this all together, again, assuming a 5% cap rate for value, let's assume you have a goal of $10 million of net worth, creating $10 million more net worth than you have today. Okay, whatever that number is today, 10 million more. And for what it's worth, you can modify all of this assumption to your liking. You can say, assuming a 10% cap rate, if you're buying kind of riskier, rural, lower quality assets, maybe it's a 10 cap. If your net worth goal is 5 million or 1 million or 100 million, or if you need to, put your pinky finger up like Dr. Evil because it goes north of that, then you can use this however you want. But using 5% cap rate for value and assuming a net worth goal of $10 million, and also assuming, just for the ease of this example, that you would like to acquire 1,000 units as well. That could be storage, mobile home parks, and I'll revisit this in a second. So let's put this together. So if you say, okay, I'm going to start with a $10 million goal, okay, times it by 5% cap rate. So you need $500,000 of net operating income to achieve your goal. You need $500,000 of net operating income more than what you have today to achieve your goal. And I will probably affirm what you're probably thinking to yourself, which is, man, that's a lot. That's a big, hairy number. I don't know how I'm going to get to that. Probably can't do it. And I will tell you, that's hogwash. You can. So let's talk about it. So let's take the $500,000 and divide it by 12 to get into monthly increments and kind of break it down into smaller parts. So you need $40,000 of NOI more a month than you currently have. And again, the same kind of cycle goes. That's a big number, probably, all of that. So let's keep going. So now we're going to take it down by our 1,000 units. So if you take the $40,000 a month that you need of NOI across 1,000 units, you need $40 a month of NOI per unit to be worth $10 million. And, some of you might say, well, that's a lot, so let's kind of keep going. And let's give ourselves 5 years to do it. So you have basically what this is saying is if you were to buy 1,000 units and find a way to grow NOI $8 per unit per year for 5 years, you would have a $10 million net worth. Now, the part of this that you can kind of massage is you could say, okay, well, what if it was multifamily and it's 500? You can modify all of the parameters, but hopefully you're getting what I'm saying here by saying you could actually reverse engineer to say, okay, what do I need to do on a monthly basis per year for every unit to get the desired goal that I'm shooting for? And you can actually reverse engineer it. And all of this has to do with your understanding of what a dollar's worth. And then there's this broader macro discussion, which, we could have it maybe on another call or whatnot, which is to say the multiples, the cap rates do change over time, but it's a pretty dynamic consideration of how that works with inflation. And it's a really fun conversation. But in simple terms, hopefully this is helpful, and we can dive into questions now if you have them. If you do have questions, you can reach out to me anytime. This is my direct line to my office in Orlando. It's my email address, and that's our website. So feel free to reach out anytime. I hope at least this portion has been helpful and valuable and entertaining, if nothing else. I did say Dr. Evil, so it's got to be entertaining to someone out there. But I will yield my time and start doing some questions.
Awesome. Thank you so much, Ryan. So looks like we got a couple questions in the chat. First one from Kurt Power, the man himself. He says RV parks are all the rage. One second. There we go. All right. So RV parks are all the rage coming out of COVID as an investment. Do you think the lack of discretionary income people will have in the coming months/years makes storage or mobile homes better investments?
So it's a great question. And Kurt, I know Kurt very, very well and think highly of him. So good to see your name in the list, and thanks for asking the question. So it depends on the RV parks they're simple to talk about, but there's a lot of implementations. There's a lot of ways you can invest in RV parks. So for example, if it's a proper RV park, more for recreation, shorter term tenancies, I'm personally and have been less bullish on that because I think it's a great asset class for late cycle, which we're seeing. I think when people were flush with cash and looking to be mobile, gas was for the most part cheap. I think that was a great model and benefited from it. I'm not as bullish in the next, in the future. I think discretionary expenditures are going to be under a lot of pressure. In short, if you look at the savings rate, we're now negative. We were actually positively saving money. Basically, a lot of Americans banked a ton of money during COVID. A lot of the relief funds went straight to the bank. And there are some estimations that the majority of that, due to inflation and rising costs, will be burned off, and almost all of those savings depleted in the next 9 to 10 months. And so I am less bullish about the economic outlook. And my friends have known this for some time. They're probably tired of me because I was not bullish a year ago. So anyway. But on the flip side of that, just to give you kind of a counterbalance to that, if it's an RV park that you're looking to kind of serve almost as a quasi-mobile home park where it's long-term tenants, however you're doing that, I have friends who are doing this. I think that makes a whole lot more sense, where it's just kind of it's almost a mobile home park under a different name, so to speak. I think that makes some sense. but I'm not as bullish on RV parks personally. And not if if you're on this call and you run an RV park business, I'm not down on you. I'm not putting my money into that space personally. I'm much more optimistic on storage and mobile home parks.
Awesome. Yeah, thank you for the question, Kurt. So next question we have is from Mav, and asking, what does kiosk-based mean?
Thanks, Mav. Thanks for the clarification. So what I mean by kiosk is like you literally walk into a storage facility and there's no human beings in it at all. Like if you were looking for the manager, they're not there. If you're looking for the maintenance person, they're not there. There's a kiosk in the office, and there's different implementations of what this looks like. But what I mean, there are companies out there where their whole apparatus is you walk into the office, you have a giant screen, whether it's on the wall or a proper kiosk, and you can select your unit, rent the unit, swipe your card, pay, get your key code to go get through the gate and get to your unit. It's entirely the entire customer experience for support, for leasing is all via a kiosk. It's all tech driven, tech enabled, no human beings. And there are some hybrid versions of this. And that gets a pretty muddy conversation fast, but that's what I meant by kiosk.
Awesome. So Ram here asked a few questions. I guess we'll pick a couple of them. So yes, one, why is multifamily so popular? He asked, how do we suggest we get into this? And I think when he's saying we get into this, he's asking about mobile homes and self-storage, and then asked, would you take money to set up? Let's see, I'll put it on there. Would you take money to set us up with mobile? I'm guessing like as a fund.
Yeah, I don't know. I'll start with the why is multifamily so popular, and work my way down. I think, and I'm not in multifamily. I'm not an active or passive investor in it, just because I kind of go back to that chart. And for clarity, I have a lot of friends that are really into multifamily and have done really, really well, and I'm thrilled for them. And for me personally, if I go back to that net operating income chart, I go back to I want to deploy my capital personally where I have the greatest chance for long-term consistent growth, personally. And multifamily, if you took away storage and mobile home parks, then multifamily was number 3 on the chart. And so multifamily would probably be my answer. But it's number 3, and I want to stick with what's number 1 and number 2, because I think they'll stay that way for the foreseeable future. So I think multifamily is also popular and has been so popular partially because of the Jobs Act. The ability to, kind of go direct to investors and raise capital, which started, I believe, on September 23rd of 2003 was when that was passed. There are a lot of new conduits, a lot of podcasts that lead to capital raising specific to multifamily. And it's not too hard from the raising of capital in that space. It's not a hard sell to say, hey, let's go buy an apartment complex. It's not a hard sell. So I think there's a lot of ability today to raise capital to buy and build those properties. It's an easy sell, and you're allowed to spread that message widely. So I think capital has flown significantly to that space, and it has also done well, which is compounded kind of that cycle.
Yeah, and I think also, they'll pitch the idea that this is, the passiveness of the investment, right? That it's just simply giving money into a fund and then receiving money back. I think is why they'll use that to really get people to come in.
Correct.
So Ryan cleared up that yes, he was talking about kind of like a fund, and he followed up. He says, "We don't know mobile home investing. How do we get into it?"
So I would say, I'll say obviously there are folks like me who, and to Zach's point, you can passively invest in an existing fund, whether it's us or somebody else, or you can actively do it yourself. I will say so. I think in the long run, if depending on what your wants, needs, and goals are, if you're looking to build something for the very long term, I would say definitely look into becoming an active owner. While in the short run, maybe taking advantage of passive opportunities just to get access to the space. There's a lot of places you can go to learn how to invest in mobile home parks. There is a lot to learn. You're probably a 2 to 3 year education curve before you'll probably feel really comfortable in the space. And even then there's barriers, to continue to grow and go from there. But I would say, how do you get into it? The easy answer is, we'll just go buy one. But that presumes you're comfortable and you know what you're doing, you know how to evaluate risk and all of that, and come up with an operating model. If you don't know how to do that, then there are places you can go to learn. And then if you don't want to do any of that, you can passively invest with firms like us or anybody else.
Exactly. Yeah. So really, you want to weigh how active you want to be. Do you want to be the one doing all this research? Do you want to be the one doing the due diligence, or do you just want to hand it off to a fund and allow someone else to do it?
Agreed. And Zach, I'll mention really quickly too, because I think it's worth mentioning. There are some people that are probably prone to active management that could do it and do quite well. And there's other people who I actually think probably wouldn't suit their personality, their risk. So I would also know thyself, who are you, who are you to you, and what are you trying to do? And I think that's probably the gating item is even if you can do all of this, which you can, is it something you want to do, and does it fit your personality and what you're looking to accomplish?
Exactly. So it looks like that's it on the question, guys. Let's see, Ryan, if you want to throw up your info, if you just want to throw it in the chat.
Sure.
Like an email, just so they can reach out to you. If you just want to share your screen, we can put it up on there. Guys, if you have any more questions at all for Ryan, go ahead and shoot them over an email. Give them a call. I know they'd be happy to help you out. If you got any questions specifically for IRAs on the IRA side, by all means, give Quest a call. We'd be happy to help out. And I'm sharing Ryan's info on the screen right now. So guys, give him a call, reach out to him. I know he'd be happy to help you. But until then, Ryan, thank you so much for coming out for us.
You bet. Thanks for having me.
All right, guys, you guys have a good weekend.
All right. Take care.